me, Kumaitile Kositile, your money manager. In today's video, I want to help you with one thing. I want to take you through how to read your loan statement. I just want to help you to decode your loan statement. Why this video in particular? I have been receiving a lot of requests from people whereby they wanted me to help them with understanding their loan statements. And it was basically reconciling the loan statement. And what I had picked is that a lot of people really don't understand what goes on into their loan statement. So that is the intention of this video, to just take you through a loan statement, how to read it and how to understand it, to avoid any surprises. I also want to encourage you to develop this habit. On a monthly basis, you should be receiving your loan statement. You can receive an electronic copy. Really, you don't need to go to your financier and ask for a loan statement. It can be sent to you electronically. Don't just receive it. After receiving it, develop a habit of reading it, understanding what goes on into that statement. This is you gaining control and getting in touch with what is happening with your loan. Something that you need to understand is that if you are paying, for example, an installment of 5,000 on a particular loan, you have to understand that on a monthly basis, your loan balance is not reducing by the entire 5,000. That is the misunderstanding that I get from a lot of people, thinking that if I pay 5,000, then it means that my loan balance is reducing by 5,000 on a monthly basis. That is not the case. You need to understand that your loan installment, that is the 5,000 that we are referring to here, is made up of two components. The first component is interest. So a portion of that 5,000 is going to go towards servicing the monthly interest on your loan. Then the remaining portion is going to go towards reducing your loan balance. So let's look at two different sets of loans. Let's say you have a long-term loan. Our long-term loan is a mortgage, 20 years, 30 years, 25 years. So in a case of a long-term mortgage, for your installment in the first few years, 80% of that installment is going towards interest, and 20% is what is reducing your loan balance. This is in a case of a long-term loan, a mortgage in particular. But when we look at the short-term loan, mostly when you pay an installment, 40% or so of that amount is covering interest, whereas 60% or so of that amount is reducing your loan balance. Why the reverse, you might wonder. I'm sure you should have picked the reverse order of things here. For a short-term loan in particular, we can look at a 5 years loan or less. You have a shorter duration or term for you to pay off the loan. This is why the bulk of your installment is going towards reducing your loan, because you have a shorter time period to pay off that loan. But in a case of a long-term loan, the bulk of your repayment when you start is going towards interest. Why? Because you have a longer duration for you to pay off that loan. So your loan is going to be reducing in very small amounts until you reach a point where we say it's a break-even point, whereby your installment is now split equally. 50% interest, 50% loan reduction, and then you are going to cross over. When you cross over, this is now when the bulk of your installment is now going to be reducing your loan, while the interest will be reducing significantly. So the interest reduces over time. Why does the interest reduce over time? It is because, remember, interest on your loan account is calculated on the outstanding balance. So as and when you reduce the balance, reduce it slowly but surely, the interest is also reducing, because interest is calculated on the outstanding balance. So I hope this is very clear, and this is really what is important for you to understand. And then you will never ever be confused when you look at your loan statement when you have this understanding. So having explained this, let's look at a loan statement. In particular, I'm going to share with you a mortgage loan statement so you can see the transactions that go into your loan account on a monthly basis. Let's look at this loan account. So looking at that loan statement, let's look at the far right. On your far right, you are going to see your loan balance as at the 15th of May 2022. You need to take note of the fact that your loan balance is a debit balance. It's not a credit, so it's a negative balance because it's a loan. That's what you need to understand. So that is your opening balance. You look at the second transaction that went into your account. On the 23rd of May 2022, there was a debit of 6,251.49. That is the calculated interest for that particular month, depending on the cycle of your calculation. So your account was debited with 6.2. When the account is debited, that is going to increase your loan balance. Do we get that? It's going to increase your loan balance. So here, your loan balance is now moving from 1,139,471 to 1,145,722. It has increased because it was debited. The interest was debited. So what do we mean when we say the interest was debited? The interest was taken out of your account. It is an expense to you. It's gonna be an income to the bank. That's their income. They're taking it from your loan account. After that, on the same day, on the 23rd of May, there was a credit. That credit, you can see, is reflected or referenced as debit order. This is your loan installment going into your loan account. So it's 10,494.64. You see it there. So what happens when your debit order, your installment goes into the account, the loan balance is going to reduce. But you need to take note of the fact that your loan balance is not reducing by the entire 10,500. Your loan balance is reducing by the difference between 10,594.64 and 6,251.49. This is what I was talking about, that your installment is made up of interest. So the first portion is covering that interest which debited your account, and the balance is what is going to reduce your loan account. And that balance in our case here is 4,343.51 thebe. This is what is confusing a lot of people, because that reduction, that balance of the loan installment that is reducing your loan account is not reflected on your loan statement. So you look at the balance. We were coming from 1,145,722 after debiting your account with interest. We are now closing the month at 1,135,127. Now I want you to work out the difference between the opening balance and the closing balance. You will see that the difference is that 4.3, which is the amount that your loan reduced by. I hope this is very clear. This is really what I wanted to explain to all of you. Some financial institutions, you can be lucky where over and above the loan statement, they can work out a table. They can show you a table showing you all of these calculations, but in most cases, they are just reflected as they are. With that loan statement, I am sure you can now confidently read and understand your loan statement. And I'm sure you have seen the point that I was trying to illustrate, to say that your loan balance does not reduce by your entire installment. However, your installment is made up of two parts: servicing the interest and as well as reducing your loan balance. And that's exactly what you saw in that loan statement. I hope this video was insightful, and this is all that I wanted to share with you today. Please don't forget to leave a comment and a like for me, and thank you very much for watching. I will see you in another video.